My name is Tim John. I'm a partner in my own accounting firm, Zwygart John Associates. I've been practicing in public accounting now for, well, in some form of accounting for 14 years. Graduated with my undergraduate bachelor's degree from Brigham Young University. I went to work for a regional firm in Boise. And while doing that, I also got my master's degree in taxation from Boise State University. I've had experience working with small businesses to large businesses. Was in a corporate tax department of a Fortune 250 company for a little while. And so I've kind of been seeing the gamut of everything. I'm born and raised here in Nampa, Idaho, graduated from Vallivue High School. And I'm happy to be here in Idaho. I've seen a lot of changes over the last 40 years, especially in the last 20. But it's been fun to have an accounting firm and to participate in helping small businesses be successful.
Excellent. All right, so I have started the recording. So for those of you who didn't show up and are watching this on the recording, we've started recording. I am going to make Tim our host. So Tim, you should be getting a notification so that you can go and share your screen.
Okay.
And for our participants, I will be monitoring the chat window. So if you have questions, I'm going to leave you all on mute so that we don't have background noise, you know, dogs and cats and, you know, all kinds of things crazy going on in the background. I know we're all home or in our offices and stuff. So, but send a chat and I will monitor that and interrupt Tim as we go along. Or Tim, if you just ask for, you know, time to take questions or something, however you want to do that. So, and again, thank you for our participants for being patient with us as we make sure that this is working out really well. Hey, look at that. I see a screen.
Okay.
So perfect.
Perfect. Yeah, this is exciting stuff. This is where I live. My world is with taxation. You know, it's crazy, this changes that we've seen in the last few months with the virus overtaking the world. It was interesting to watch people's behavior. And I myself was not panicked until I saw an article where they said that diet soda might be in trouble because it's all aspartames produced in China. And I am a avid Diet Mountain Dew drinker. So that's when I started to panic, and I made a personal run on Diet Mountain Dew. So if you're all out, it's my fault. I apologize. I've kind of already introduced myself and my firm. So to truly understand business entity classification for tax purposes, it's important to start and help an understanding with the various different types of taxes that a business or an individual might pay. This is something that I find a lot of my small business owners have not been exposed to, and they really struggle with this concept of these different taxes. And some of my brother's a perfect example. My brother's a dentist, a very intelligent guy. And after all these years, I still have to explain to him the different taxation levels and different types of taxes. And so it can be really confusing. So we're all fairly comfortable and familiar with an income tax. That's something we've been exposed to our whole lives. That's where we pay our personal and corporate or our personal income taxes. And so, you know, we're used to having our W-2s with our withholding for federal and state, and then we file our tax return at the end of the year and report that income, and then we see how good we were estimating with our withholding, and we either get a refund or we have to pay a little. Sometimes when we have investments, we also have capital gains. Capital gains, based upon whether they're short-term or long-term, can be taxed at different rates. Short-term capital gains are taxed at your ordinary income tax rate, but if they're considered long-term capital gains, they can receive preferential treatment. And there's 3 different levels of capital gains taxation based upon your adjusted gross income. If your adjusted gross income is low enough, they could actually be taxed at 0%, or they can be taxed at 15%, or they can be taxed at the cap maximum, which is 20%. We're also familiar, for the most part, with payroll taxes because most of us have worked as an employee, and therefore we've seen the payroll taxes, the Medicare, Social Security withdrawn from our paychecks as we've earned it. The self-employment taxes, this is the one where I find most small business owners struggle with and don't understand conceptually. The self-employment tax is basically a payroll tax for people who are self-employed. It's the exact same rate. Payroll taxes are subject to a 15.3% tax burden that's split up between the Medicare and Social Security. When you're working as an employee, the law states that the business pays half of that. So that's why as an employee, you only pay 7.65. Your employer pays the other 7.65. When you're self-employed, you get the wonderful privilege of paying the full 15.3. And that is one where, as we talk about entity classifications, I think a lot of my small business owners will sometimes get surprised and shocked, but we'll talk about that in just a second. There are a lot of other taxes that really don't apply right now. There's the net investment income tax, which is a part of the Affordable Care Act, which is an additional tax on investment earnings if you cross certain thresholds of adjusted gross income. There's an additional Medicare tax on self-employed income that's also part of that Affordable Care Act. But again, those aren't significant and really not worth discussing at this time. So let's dive right into our first and probably the most common type of business entity setup for tax purposes, and that is the sole proprietor. The sole proprietor is very simple to organize and set up. All you do is you just start a business. The individual is the business. Your social security number and this business are perfectly tied together. The IRS looks at them as one and the same. You can go and get an EIN for a sole proprietor for purposes of payroll tax if you don't want to use your social security number for filing payroll tax forms, which I would recommend doing an EIN if you're going to be processing payroll for a sole proprietor. But what makes a sole proprietor so easy, there's nothing you have to register with the state of Idaho. There are no additional tax returns. It's a separate schedule on your personal tax return. It's a Schedule C. You report all the business income and the business expenses on that Schedule C. And the profit that's calculated or loss just flows through and is part of your calculation on your personal income tax return. The employee, as the owner of a sole proprietor, is not allowed to pay themselves a wage, a W-2 wage. And so again, if you're the only person working in your business, a sole proprietor is incredibly easy to open, to maintain, and to operate. Going to our conversation of taxes. So when you have the profit within a sole proprietor, that profit is subject to two taxes. And this is where a lot of my small businesses, especially when they're first starting out, get caught in misunderstandings. So if you have a sole proprietorship, you do really good your first year, you have $100,000 of profit. That $100,000 of profit is subject to both your income tax calculation and a separate self-employment tax calculation. So if we have that $100,000 of profit, if you were utilizing a standard deduction and filing status as married, filing joint, rough calculation, just your income tax on that $100,000 of profit would be a little over $6,100. But your self-employment tax on that same amount would be a little over $14,000 for a total tax liability of $20,000, a little over $20,000. And again, this is where most of my small business clients get in trouble because they haven't prepared for this type of a tax burden. Most people don't have $20,000 sitting around to pay this tax. They understand the income tax, but they don't understand why they owe so much from their business profits. But that's the self-employment tax that is kicking in. And so again, you gotta remember the self-employment tax is effectively a payroll tax. This goes into your Social Security calculation. So this will go as reported to Social Security. These are your Social Security taxes. So down the road, when you decide to withdraw Social Security, that's where the Social Security Administration will start uses their calculation. It's that self-employment income and self-employment tax that you paid. So it's not all bad, assuming, if you believe that the Social Security will be around when you retire, then it's not terribly bad, as long as you're prepared for it to pay that tax. And again, that's the difference between the payroll tax and the self-employment tax. Is usually if you're paying payroll, you're doing a normal cadence every 2 weeks or twice a month or once a month or whatever the payroll cadence is. So you're paying that payroll tax throughout the year. Whereas when you're self-employed as a sole proprietor, you're paying that full self-employment tax when you file your personal tax return at the end of the year. So I always recommend to my clients who are self-employed and running as a sole proprietor that they've got to set aside at least that 30% is what I would always recommend, to set aside 30% throughout the year, so that when they get their tax bill at the end of the year, they've got the money set aside to pay it. There's no worse feeling than me as a tax CPA sitting across the desk from my client and then seeing their shocked face of owing 20 grand, and then they tell me they don't have 20 grand to pay the tax, and it's never a fun conversation for me to have as a CPA. And so if you're prepared with that knowledge of setting that money aside, then it's a lot better for you as a sole proprietor. The other aspect we have to talk about for sole proprietor, and this is more of a legal aspect than it is a tax aspect, and I'm not an attorney, I can't give legal advice, but we'll just touch on it real briefly. Because your business is tied to you as an individual, you have the liability of the business. And so if you're driving your truck, your car out on doing business and you get an accident, it's your fault, and you get sued, they can sue your business as well as you personally. And my understanding is that they can sue you for your personal assets, not just the business assets. So they can come after your home and your other personal assets, your savings, personal savings accounts, and those types of things. So you have the unlimited liability that you have to watch out for as a sole proprietor. Question?
Hi, Tim. Sorry. Alex asked, do you recommend paying quarterly, and do you recommend holding those funds that are set aside in a high interest savings account?
That's a great question. You know, if the tax liability reaches a certain point where it's over $1,000 of tax due, then we're required to start paying on a quarterly basis to avoid paying penalty and interest in April. And so, yeah, I mean, if you can set that money aside and put it aside in a high savings, interest account, yeah, that's great. You're making a little bit of money while you're setting it aside, and you've got the money to pay those quarterly payments and then the money to pay that tax. What I find for most of my clients is that they usually start as a sole proprietor and they're losing money for like the first couple of years. And so they're just trying to think about it. Then all of a sudden they just rock it off and they have their first year where they have a $40,000 or $50,000 profit, which it's not a lot of money, because most of my sole proprietors, they're taking that money to live on, that $40,000, $50,000. But then, we run that same calculation. Well, $50,000 subject to basically a 30% tax of 15.3 plus 12 is the lowest tax bracket. And you're at a 27%, so 30%. So all of a sudden I show them that they owe $15,000 on their $50,000 of profit. And they're just flabbergasted because they took every penny they had made to live off of, and they weren't prepared because they've been losing money. And so it's usually that first year that catches people, the first year of profitability. So if you're recognizing that you're having a good year, you got to use great self-control and start setting money aside instead of trying to use all that money to continue to grow your business, or all that money to supplement your lifestyle. So great question. So we're going to touch base real quick on corporations. Corporations are the oldest and most recognized form of doing a business. It's just called a traditional. Yes.
I'm sorry, Tim, one more question. Why do you recommend setting aside 30% if we only pay 15.3 in taxes?
The 15.3 is just the self-employment tax, so that's one of the taxes. So again, remember that profit is subject to both your self-employment, which is 15.3, plus your personal income tax rate, which is that minimum of 12. And so the combined of the two is 27.3. So if you set aside 30%, then you're also setting aside for the potential Idaho tax that will be due on those profits as well. If that makes sense.
She says thanks.
You're welcome. So the corporation, the corporation is a separate legal entity, and it has been around forever. There's actually quite a bit of case. They've been around for hundreds of years. And so the case law around corporations is very well established. People know how to treat corporations. Like I said, it's a separate entity, so it has its own liability, and that's why a lot of people will set up corporations, is because it protects those shareholders for the most part who own the shares of the corporation. If the corporation gets sued, then they have to stop at the corporate level. assuming we've been doing everything right. And this is sometimes small business owners get in trouble with this because if we commingle personal and business, then we can lose that liability protection from a legal perspective. Again, I'm not an attorney, so I think an attorney would explain that, right? The problem we run into with a traditional corporation is that we're involved with double taxation. Since it's its own legal entity, it pays tax on its profits. The only way that an owner can get money out of a traditional corporation, what we call a C corporation, is to either through wages, which your wages are subject to the payroll taxes, or through a dividend. So if you have, let's say you have let's continue our example, we have $100,000 profit of our corporation, but we've paid, out of that 100,000, we've actually allocated half of that to our wages. Once we factor in payroll taxes, then the payroll taxes will be a little over 8,000. The profits remaining will be about 47,000, and that will be subject to a flat tax of 21%. The recent Tax Cuts and Job Act have changed the C corporation tax bracket to a flat 21%. It used to be a progressive tax rate bracket, just kind of like individuals. So that 47,000 would generate another $9,600 of taxes that the corporation would pay. So at that point, we would have some profit left over, $35,000. But the only way to get that out is through a dividend, which is not an expense to the corporation, and it would actually becomes income to the shareholder and is taxed at those long-term capital gains rates. So it could be taxed at 0 or it could be taxed at 15%. And so I don't know if I've ever had a client or I've ever recommended a client set up a C corporation because of that issue of double taxation. There are some situations where it's required. I mean, if you're going to be a business that's exchanged on a stock market, then you're required to be a corporation. For the most part, there are some publicly traded partnerships, but for most instances, you have to be just a traditional C corporation to be listed on the stock exchange. So we won't spend too much time here because, again, it's just pretty rare anymore. So even with that 21% flat rate, this is probably not, from a tax advantageous perspective, it's not that advantageous compared to some of the other options that we have. It's less tax than a sole proprietor in most instances, but it's still, we have better options for us. You've probably heard of the limited liability corporation. It's called an LLC. This is a relatively newer, by newer, I mean, it's been around for 30 or 40 years. I think it started coming out in the 60s and 70s. But in terms of case law, it's relatively new, and a lot of the issues that have been hammered out in the courts with C corporations over 200 years are still just kind of working their way through the system now for LLCs. LLCs are a hybrid type entity. And let me take a step back too, because it's really important to understand that these types of, the legal entity structure is something that we have to set up at the state level. The IRS defers to state law. And so state law, in this regard, to setting up a legal entity. And so the IRS says that whatever your state allows you to set up is what we will recognize. And so in order to set up a corporation, you have to go to the state of Idaho, Secretary of State, and file the correct paperwork to set up your corporation. The same thing with an LLC, and the same thing if we wanted to set up a partnership. All that is done through paperwork through the state of Idaho. And then the IRS will just come in and say, hey, we recognize what you have done at the state level. But there are some things that the IRS does that don't really translate at the state level. And so we've kind of got these interesting little nuances. The LLC is kind of one of those. So this LLC, we have 3 different ways we can actually treat an LLC. And they're very flexible. So if we have one owner, when we set up an LLC, it's interesting because at the state level, you file the exact same paperwork. But the IRS looks at what we call a single member LLC, or an LLC with one owner. And the IRS says, hey, that just looks like a sole proprietor. And so we're going to call this a disregarded entity. We're not going to require you to file a separate tax return. We'll just treat it like it's a sole proprietor. We'll just treat it, and you file it on your personal tax return as a Schedule C. And so that's a pretty neat little feature, because then we were talking about one of the big downsides of being a sole proprietor is unlimited liability. So if we set up an LLC at the state level and it's a single member LLC, well, we can actually get the liability protection of having a separate business. The same thing with an LLC. but we still have the easy treatment of a sole proprietor. So it's kind of a nice little sweet spot. I mean, we still have to deal with the self-employment tax. Again, it's treated just like the sole proprietor. An LLC can, for tax purposes, you can choose when you set up an LLC, if it's more than one member, we can choose to be taxed as a partnership, or we can choose to be taxed as a corporation. It's truly flexible. Again, I've never set up an LLC and had it taxed as a corporation because we've talked about the double taxation rules. So in most instances, when I'm setting up multi-member LLCs, we're going for partnership treatment. And there's some reasons we do that versus just setting up a traditional partnership type entity structure. So the interesting thing about an LLC, and with the same thing when we talk about partnerships, is that the profits may or may not be subject to self-employment tax. It depends upon your involvement in the business. We have rules about material participation. And if you are materially participating within a business, then those profits that flow through to your personal tax return are subject to tax, to self-employment tax and the income tax. The LLC is receiving an additional IRS scrutiny right now because people are, again, the case law is relatively new, and people are trying to use LLCs in very unique ways. And so they are receiving IRS scrutiny at the time. So it's important to distinguish too the difference right now between a corporation and what I'm going to call a flow-through entity. Because I mentioned it briefly as an LLC. If we treat an LLC as a partnership, then the profits from that business aren't taxed. The partnerships don't pay tax. LLCs that are treated as a partnership don't pay tax. The profits or the loss that we calculate on that separate tax return get reported on a form called a K-1. And that K-1 flows to each of the individual partners or owners of that partnership or that LLC, and that is picked up on their personal returns as income or loss. And so that is a nice aspect of a partnership or an LLC tax as a partnership, that they actually don't pay tax at the corporate or at the business level. It's all reported on the personal tax return. And so we're starting to get into more of what we see as small business owners of the entity structures that we normally deal with. So we're continuing, we just move right into the partnership. Partnerships are incredibly flexible types of entity structures. The reason they're flexible is that it will make a little more sense when we talk about another form of a corporation, but partnerships are flexible. Again, they don't pay tax. The profits and the losses flow through. But we can effectively choose how we want to allocate profit and loss if we meet some certain rules. So the IRS allows a partnership to allocate items of tax or income and deduction based in a partnership on one of two ways. You can allocate on a partner's interest in that partnership, which is the easiest way, probably the standard way to do that. Or you can try and get super crazy and just allocate it any way you want. And we can do that if we meet a complex set of rules called the substantial economic effect safe harbor rules. This is like crazy complex stuff. If you guys wanted to do this stuff, I would love you to death because it allows me to charge crazy fees and it's awesome. And it's a calculation that you have to meet every single year. And because of that, a lot of times most businesses or partnerships are not in compliance with that safe harbor because it's really easy to break these substantial economic effect rules. But the option is there. You know, you can set up a partnership where you have two partners that own 50-50 of the partnership, but we can say we're going to allocate 70% of the income to partner A and 30% of the income to partner B. And as long as we meet those substantial economic rules, we can do it that way. And so, you know, it's one of those things that's very flexible. There's a newer way I was just reading about that are people allocating on, and I have not seen it. And so I don't want to bring it up to confuse people. But again, there's the flexibility of a partnership is what makes them unique. So comparing this to an LLC, like what's the difference between an LLC and a partnership? most partnerships have what they call a general partner, at least one general partner. The others can be limited partners. A general partner assumes all the liability in regards to the partnership. So people, when a partnership gets sued, then a person can sue the partnership and they can sue the general partner. And then so that general partner has unlimited liability in most instances. Limited liability partners, or the limited partners, usually don't have the liability. It stops at the partnership level. And that's what's unique about an LLC is an LLC doesn't have a general partner. They're member managers. And so when we talk about a liability perspective, an LLC seems to provide more liability protection to all partners compared to a partnership. Again, that's a great legal question to ask an attorney, but that is my understanding. All right, now this is where I probably spend the majority of my time is in an S corporation. So we have our C corporation. Don't get confused between a C corporation and an S corporation. A C is the traditional style of corporation that's exposed to double taxation, whereas an S corporation is an additional form. It's a flow-through entity that allows, so it doesn't pay tax, but the profits and losses flow from the corporation, the S corporation, down to the individual shareholders. So this is one of those where it gets a little tricky because an S corporation is strictly a tax IRS structure, entity structure. Like if you were to go down to the Idaho Secretary of State and say, I want to form an S corporation, they would tell you you can't. You can't, there's no legal entity called an S corporation. So what you actually have to do is you have to set up a corporation or an LLC or a partnership first, and then we tell the IRS that we want that entity to be taxed as an S corporation. We make an election and we tell the IRS to tax this entity as an S corporation. What that does is it gives this a really favorable entity structure that allows us to allocate income or profits based upon the shareholders and how many shares that they own. Because S corporations are very tax advantageous, and because of that, there's a lot of rules set up around them to do it properly. There's strict requirements on who can own the shares of an S corporation. So an S corporation share can only be owned by an individual who has to be, they can't be foreign, they've got to be a US citizen. You can't have multiple classes of shares. And so you can't have like a common stock and a preferred stock type of shares. It's all got to be uniform. There can only be 100 shareholders. It's got to be 100 shareholders or less. And so in those types of arenas, you've got to be very careful. I've seen that happen with attorneys who are not as familiar with the S corp rules, where they'll set up for estate planning that when, let's say, mom and dad own a business, they'll set up estate planning that one of them passes, that their share of the estate will go into a trust. And that trust will, hold out for 15 years, and that profits from that remaining S corporation will flow to that trust, which then flows to the beneficiaries. Well, that's an unallowed shareholder, and it can blow up the S election. So what makes the S corporation so advantageous? Now, that's a great question. So the reason for that is profits that flow through from an S corporation. Again, they flow through on the exact same form, that form K1. The S corporation doesn't pay tax at the entity level, but the profits will be reported on a K1 and they flow through the shareholder's tax return. Those profits are not subject to self-employment tax. And that is what makes an S corporation probably one of the most used entity structures, at least from a small business tax perspective. So your first thought would be like, well, if my profits aren't subject to an S corporation, why would I be in any other type of corporation? Because I can save that 15.3% on self-employment tax, and I'll only be subject to my income tax. That sounds too good to be true, which it is. So the IRS rules regarding S corporations is that they realize, hey, there's great incentive here for these owners to not subject any of that income to self-employment tax because it's not subject to it. So we're going to require that if you are a greater than 2% shareholder in an S corporation, that you pay yourself reasonable compensation. So The reason for that is because they want a portion of those profits to be subject to that payroll tax / self-employment tax. But this is where we get to have a little bit of fun, and we get to determine how much of our profits we want to subject to that payroll tax, that self-employment tax. So for our example of, let's say we have $100,000 of profit again in an S corporation, all of that would flow through, not subject to self-employment tax, but we can't do that. So we got to subject part of that through paying ourselves a wage. So let's say we pay ourselves a wage of $50,000. We have to pay the associated payroll tax, that, which we do. And then the remaining of the profit flows through to our personal tax returns, only subject to the income tax. In that scenario, when I compare it to that same $100,000 in a sole proprietor, so that if we calculate how much we would pay on payroll tax, if we calculate how much we would pay on the income tax, the remaining profit, for the S corporation, total payroll tax plus income tax would be a little over $15,000 compared to a little over $20,000 in the sole proprietor. So the same profit, $100,000, we get to save $5,000 a year just by setting up an S corporation, paying ourselves a reasonable compensation, and then letting the rest of those profits flow through to our personal tax returns, not subject to self-employment tax. What is reasonable compensation? Boy, that's the question, and that's the game. There's no bright line test. There's no way to say this is reasonable compensation. It's always a facts and circumstances based analysis. The majority of the court cases where we've seen the IRS come after S corporations for not paying reasonable compensation has been when the owners have paid themselves zero. And ironically, it seems like most of the court cases where that's the scenario, it's accounting firms. So the CPA, for whatever reason, decides to get super aggressive and has a practice where they're not paying themselves a wage and they flow through all the profits free of self-employment tax. That's the easiest audit that I have seen on S corporations, almost in any structure. If the IRS sees an S corporation with profits and you actually have a separate line where you have to report owner compensation, if that line says zero, I can almost guarantee you that that's going to be audited and you will lose. There's no footing to stand on there. But we can play this game because that $5,000 savings in self-employment tax, that's a savings that if your business is consistently a profit of $100,000, that's a $5,000 that we will save in self-employment tax every single year going forward. If you're also paying attention to our conversation, your Social Security calculation is only based upon what's subjected to payroll tax or what's subjected to self-employment tax. So you've just removed $50,000 of income or wages from your Social Security calculation. And so we've experienced, I've talked to some CPAs where they've set up these types of strategies, and because these strategies have been around for years, but they've set up these strategies for clients for over 30 years. They've just been playing this game where they've only been paying in very minimal wages and everything else has been flowing through. The IRS has let them go, it's been perfectly fine. Then they go to retire and they see that they're only getting $10,000 a year in Social Security. And they're frustrated because they thought that this great game, they didn't realize that this game was going to hurt their Social Security. What I would tell my clients is what we're saving in self-employment tax, what I would sure love to see you guys put into a type of a retirement account, an IRA or 401k. We have lots of options there for retirement planning purposes, but take those savings and set them aside knowing that your Social Security calculation is going to be less in the future. Okay, looks like I've covered all my points on that. So do you have any other questions based upon, I feel like I've just unloaded 14 years worth of knowledge in just 30 minutes. And so do you guys have any questions?
So I'm going to go ahead and unmute everybody. At least I think I'm going to unmute. Actually, that may be something that you have to do, Tim, or you have to give me back control. So let me see. You can always chat or you can unmute yourself if you have questions. Yep. I think it must be you, Tim. You have to give me back control. Oh, Alex has another question, so I'll just read it out. When filing a single member LLC, how would that affect filing with a spouse? Still file jointly?
Yes. You file a joint tax return, and it's an additional schedule that is included on your joint tax return. And that's a great question. And that's a question that you frequently get is it better to file married filing joint or married filing separate? Almost universally, you get a better tax answer by doing married filing joint. I do have some clients that do married filing separate, but that is more in relation to they're elderly and they're on their second marriage and they're just trying to keep finances separate for their beneficiaries once they pass on.
Okay. Anyone else?
If there's no other questions, I got something I just real quickly, I just would advise that you get tax advice on situations. I can't tell you how many times I have clients come in to me and say, okay, this is what I was told by so-and-so, and we're moving forward on this type of a transaction. Let me give you an example. I have a client that came in that they've had 5 acres that's been in the family for generations. It's since the 1900s. And they've owned it. It's been passed down. We just got zoned commercial. They're looking to sell this land and sell it for almost $1 million. And they had somebody tell them that they could transition that property through a like-kind exchange and avoid all gain on that. So we do have provisions with real estate to do what we call a like-kind exchange, where we can transition, we can exchange one piece of property and defer gain in that into another piece of property. But under this fact pattern, we might be able to do it, but there's quite a bit of research I would have to do and hoops we'd have to jump through to make sure it would be done appropriately. But my client was coming to me and the properties, they've got an offer on the property and they were going through and going to do the like-kind exchange. And if I hadn't talked to them, this is something after the fact, if they do it, this transaction could explode on them a year down the road. And the IRS is always at least a year behind. So when you do a transaction, let's say we do that transaction in 2020, that'd be reported on the 2020 tax return, which would be April of 2021. The IRS at earliest would audit that transaction in 2022, most likely the summer of 2022. And if that transaction had to be unwound because they didn't check all the boxes to meet a like-kind exchange, we're talking about almost a year and a half after the fact, where in the interest and the penalties associated with that unwound transaction would be gargantuan. Plus, most people have spent the money by then. And so if you're going to do large transactions, please reach out and get advice beforehand. There's things that we can do as a CPA to, at a minimum, we can prepare you for the tax that's going to be due so that you can set it aside. But in the best case scenario, we can set up a strategy to defer a lot or most of the gain. That's just an example of the power of getting good tax advice and taking advantage of that.
So we have a couple more questions. Great. Thank you guys for, guys and gals, for piping up. So Jessica wants to know, what kind of deductions can an LLC take?
Those are great questions. You know, the tax code is actually pretty fascinating on that because it's a code section 162. I think it's code section 162 is what starts talking about business deductions. And it starts off very generically. And it says, you can deduct anything that is necessary for normal business use. And then we get hundreds and hundreds of pages of exceptions to that rule of what's not allowed. And so a perfect example is they say, okay, anything is deductible that's necessary to operate your business. But then there's a rule that says, but we're not going to allow you to deduct meals and entertainment. And then there's an exception to that rule saying, if it's for business purposes, we'll allow you to deduct 50% of meals, costs associated with meals. We used to be able to deduct 50% of entertainment. That's something that just changed in the recent Tax Cuts and Jobs Act. We're no longer allowed to deduct any entertainment expenses. And that can get a little complicated when you're doing a joint cost. Like if you're taking a client to a Boise State game and you're bundling the cost of the ticket plus food. Let's say you get one of those suites and it's just $500 a person to go to the suite to watch the game and have all the food. You've got to do some type of an allocation to break out what cost is associated with the entertainment side, what cost is associated with the food side, and then just allow the entertainment side. A big question I get for small business owners is cars. What can I deduct for purposes of my car? There's two ways that we can deduct vehicle expenses. We can actually put the vehicle in the business and start deducting all the associated costs. We can deduct repairs and maintenance, we can deduct fuel, we can deduct, we get to depreciate the car, we can deduct all of that. The caveat to that is that it's on a pro rata calculation. So we have to track our mileage, and you have to just track how much of the mileage that you drive is for business versus personal. So then if we're 40% in business use, then we get to take 40% of all those expenses as a business deduction. The other way we can deduct mileage in a vehicle is to leave the car out of the business, and we just do a standard mileage rate where the IRS allows us to, we have to do the exact same tracking of mileage, total miles and how much of that total miles during the year is business versus personal. And then the IRS gives us 58 cents, I think it's 57 and a half in 2020, but last year is 58 cents per mile as a deduction. I like the standard mileage rate personally as a CPA because if you are ever to come under audit, the IRS will demand three things. They'll demand the mileage log. If you cannot produce the mileage log, so you're supposed to be, the mileage log is supposed to be what they call contemporaneous, meaning you're supposed to be tracking that throughout the year. If you produce the mileage log after the year, they can disallow the entire thing. So you have to make sure you're on top of your mileage log, doing it throughout the year. So that's what the last four first is your mileage log. Then if you have the actual vehicle in the business, they'll ask for receipts to prove your expenses, and they'll ask for the bank statements to show those transactions actually hitting the bank account. Most of my clients are not going to be keeping every single receipt that they have for filling up with fuel, for an oil change, for maintenance, all that type of stuff. And so for my clients, I just say, please do the standard mileage rate. It's so much easier. So all we have to worry about if we ever under audit is that mileage log. So that's another big one that I always hear from small business owners is on mileage. But in terms of other expenses, again, the standard, the law is anything that's ordinary and necessary to operate your business.
Thank you. Alex asks, do you have any good resources that you recommend in regards to maximizing tax deductions?
I guess the biggest resources that I see are just, so there's apps out there to help you track your mileage. I would say if you're doing a lot of driving for business purposes, download one of those apps to help you track your mileage. Then I would find one of the things when we set up a business, what I would highly recommend is you set up a separate business account at the bank and run all business transactions through that account. Make sure you don't run your personal transactions through there. You want to keep those separate. That by running everything through the business account separately, it's going to make it easier to track all your business expenses. Here's an example. I just picked up a new client, small business, just started out last year in 2018. So 2019 is his first year being self-employed. We ran through his business account and he was showing a lot more profit than he was prepared to share. And then he realized that because he was running a bunch of business expenses through his personal account. So now he had to go through 12 months of his personal checking account statement to find business expenses and to track those. And that's just a lot of work to track those expenses. So if you just ran everything through a business bank account, that allows you just to keep everything. Try to avoid cash transactions, because it's hard to track what cash was for. And although you might think you remember 13 months from now what you withdrew $100 out of the ATM for, chances are you won't. And as a CPA, that's what people don't understand. I'm assuming a degree of liability myself. And so when I have clients come in and they say, I took $100 cash out and they can't tell me why, that I classify that as an owner draw. An owner draw is not a business deduction. It's money taken out of for the owner's personal benefit. So that increases your tax liability, because if I'm in a position as a CPA where I am taking deductions that I know probably wouldn't withstand IRS scrutiny, I can get in trouble and I can face penalties from the IRS. And I could potentially, if they're egregious enough, lose my livelihood. And so when you're working with a CPA, you got to understand that I'm at risk as well. And so if you can't justify what that $100 is for, then I'm more likely going to take it to cover myself in a situation so that I'm not at risk as much as you might think I am.
So nobody's asked this, but I get this from my clients a lot about the taxes that go along with having an employee. And I know from my perspective as a business consultant, sometimes people will say, well, you know, I'm just going to hire them as an independent contractor so I don't have to deal with it, which I can tell you is not the right way to go. The IRS in particular is looking very hard at businesses that have independent contractors to make sure that they meet the specific guidelines. And there are very specific guidelines with whether or not somebody is an employee versus an independent contractor. And just because you don't want to deal with taxes is not the reason to have them as an independent contractor versus an employee. So do you want to expand on that a little bit, Tim?
Yeah, that's a great question. And I'm glad you brought that up, because that is one that not only is the IRS really starting to scrutinize that, I know California has come out and said that they are, in fact, California's got some proposals out there that almost make it impossible to code people working for you as independent contractors. And so it's getting really, the states are looking at it because everyone's losing out on potential payroll taxes. And let me take a step back too, because we talk about that conversation of income taxes versus payroll taxes. If again, we get in a situation where people maybe don't have the cash to pay taxes, the IRS is actually really easy to work with when you owe tax and you can put a payment plan to start paying those taxes back. But if you start withholding, like not being able to pay payroll tax, boy, that gets ugly really quick. The IRS does not like you not paying your payroll taxes. And so if you're hiring somebody who, for all intents and purposes, is an employee instead of an independent contractor, that can get ugly really quick, because the IRS will come in after the fact, reclassify that person as an employee, say, okay, well, you paid them $40,000 over the last year. Well, we're going to demand that you paid that over the last 4 quarters. Here are the associated payroll taxes with that you're now late by over a year on. So we're going to rack up interest and penalties, and the interest and penalties can be, I think, cap out at maybe 25% of the outstanding liability. So it just adds up really quick. But and we have a whole bunch of tests to determine whether somebody we hire is an independent contractor versus an employee. And there's not one smoking gun, but if you can control their schedule, if they only work for you, if you provide them the workspace and the work tools, then they are an employee. And I would say it's not like at our firm for us, we help a lot of clients do their payroll and we do their payroll taxes for them. It's not expensive to hire somebody to do this for you. In our firm, we actually assume the liability. So if there's a mistake made, we pay the associated penalties and interest. And so, I mean, we're talking $100 to $200 a month for us to do all that for you. And so it's not worth the risk to have somebody come back, to have the IRS or a state come back and reclassify an independent contractor as an employee, because the penalties are just severe. And in those types of situations, a lot of times I know the state will come in and just start pulling money out of your bank account, and they don't give you the option. And so it can jeopardize your entire business. And so it's not hard to get it set up and to get it done right. I mean, there is legwork to get it set up the first time, but once it's set up, and maintaining a payroll process, it's not hard.
Okay. Thank you. Does anybody else have any other questions? And I just unmuted all of you, I think, for the most part. So. No? All right. Going once, going twice. Okay, so just to wrap this up, to let you know, we're here to help you in whatever way that we can. And Tim has given you his contact information, and by all means, take advantage of that. He is a professional, and so he does charge for his services. So, but he also is a professional and knows what he's doing. We are here for you, and we can help you to a certain point, but we are not tax experts at the SBDC. So usually when we start getting into deeper questions on taxes and stuff, I send you to people like Tim, because I don't read the tax code. That's not my my way to have fun. I'm assuming that's what Tim does for fun. So
I believe it.
woohoo, lots of fun that way. But it's so reassuring that we have people like Tim around, because I'm not a numbers person, and that's just not how we do things. So I appreciate all of you pivoting for us so that we could go online, so that we can all protect our health. I'll be talking to Tim about future classes, and please keep in contact if you have questions about your business. We are working right now to put as many resources online available virtually for you as we can, as quickly as possible. So if you have suggestions or needs, please let us know, and we'll get to them as soon as we can. So with that, Tim, do you have anything else you want to add?
No, just thank you for allowing me to be here.
All right. Well, thank you all so much. And I'm going to go ahead and end the meeting. It'll take a little bit for it to download and record and upload and stuff, but sometime this afternoon, look for an email with the link to it up on YouTube. So, all right. With that, I bid you adieu and enjoy the rest of your afternoon.